we put out a lot of articles on our website every day covering everything from the markets to investing to, I've got an article tomorrow about investing rules, the things you should follow to be a better investor. The one thing we talked about before is that, having an investment strategy is fine. The biggest fallacy for most investors is that the first time their strategy doesn't work, they abandon it to do something else. No strategy works every single time. Ty Cobb was in the Hall of Fame as being one of the greatest batters of all time. His batting average was about 350, right? And that got him into the Hall of Fames. And that means that every time you go up to bat, you're getting one hit out of every 3 times at bat. Now in investing, that's not going to work. You're going to wind up losing money. And in investing, you need to be about a 60% hitter, but that doesn't mean that you're going to win every single time. And so what the article covers tomorrow, and I certainly encourage you to go by the website, Real Investment Advice, to get it, is covering this idea about strategy and 10 rules that always work no matter what. And if you follow those 10 guidelines, you will be a successful investor over time because you simply have to be, right? I mean, it's just simply going to work out that way if you follow the discipline. So that's going to be on our website tomorrow morning. So be sure and get by there, realinvestmentadvice.com. You can also get our live stream as well. So while I'm talking about the markets or we're doing the show, feel free to watch the show. We'd love to have you actually tune in and watch the show either on facebook.com/realinvestmentadvice or at our website, realinvestmentadvice.com. Either way, you can also get all of our podcasts and our video cast on the website every single day, also under the media tab. So, all right, let's talk a little bit about the markets today and what happened. So this has been a continuation today of really this breakout of consolidation. As I've talked about over the last couple of weeks, we had the market building this consolidation pattern where prices were getting squeezed more and more into a very tight range. And we talked about last week, and we kind of reiterated this a few times, that we've been raising cash through this process, but that if the market broke out to the upside, it's going to be like a bit of a coiled spring. So you would see a break to the upside, and that's exactly what we saw happen. We saw this breakout. The market moved above the 100-day moving average, good level of resistance for the markets, and when we got above that resistance level at the 100-day moving average, that really gave us some clearance for the markets to move further up from here. But this move had already absorbed a lot of the oversold condition that existed. And so this pullback over the last couple of days came down, retested that previous resistance that now turns that into support. So this support now begins to form the bottom of potentially a new move higher. So we'll want to keep a close watch on this. If the market can move above this recent high that we just saw earlier this week, we're going to have a good shot at moving up towards about 2,800 on the S&P. Now look, that's not a huge range here, mind you. We're at 2772 today. So you're only talking about 20, 30 points from here before we run into trouble again. So keep a watch on this. But again, we did add some exposure to portfolios. We had a couple of little positions today as well. We're just kind of working our way into this a little bit at a time. We're not getting overly anxious. There's still a lot of trouble ahead. We're moving into summer, which is typically weak anyway, but we have a lot of things that are going on. North Korea, China trade deals, Iran, Israel. The economic data is not exceptionally strong here. We've got a very lopsided market with investors incredibly in short bonds, very long stocks in energy. And when you have a very, very lopsided market as we have now, and particularly talk about interest rates are above 3%. That tends to weigh on the markets as well. So we've got a lot of things potentially that could lead to some trouble for stocks. So while we're putting a little bit of money to work here, we're still holding a higher level of cash than normal, just in case we either get another pullback that allows us to add some additional exposure at cheaper prices, but also allows us to kind of weather what's going to go on this summer until we get a better opportunity and a clearer opportunity that we want to add more exposure. Having some cash on the sideline allows us to short the market if we need to hedge, or to buy additional bonds if we need to buy fixed income. Lots of options with having cash. So instead of being fully allocated all the time, remember that allocation is a function of measurement of risk. And talking about how much risk you're taking on in the portfolio is a question of how much money you're going to lose when you're wrong, and eventually you're going to be wrong. And this is the fallacy of investing, which is you're always told that you have to be all in the market, but you don't. There's no rule or law that says you have to be 100% invested all the time. The thing is we want to be invested when the risk reward is heavily in our favor. Right now, risk and reward is in our favor, but not dramatically so. This is why we're taking some exposure to markets, but we're not just going, head first and buying everything in sight. We're being very selective about what we buy. We're trying to buy value. We're trying to buy opportunity, and we're staying very in large liquid names as well to make sure that we have ability to move and effectively hedge portfolios in case something goes on. So keep a watch on what's happening here in the markets. Be sure to get by our website. We update our analysis every Tuesday and every Saturday. So if you click the subscription button at the website, we're happy to have you join the other 25,000 some odd people on our website to get our newsletter and blog posts every week, and we'll keep you updated. And in our 401k Plan Manager, it's in our weekly newsletter. That'll help you keep your 401k plan allocated as well. So whatever we can do, we're always happy to do it. You can go by the website, ask questions, schedule appointments, whatever. It's all at the website, realinvestmentadvice.com. And again, that's, whether it's financial planning or whether it's investing, these are all very important things, particularly as you start moving towards retirement. And importantly, and this is something that I'm writing about for Friday when we put out our weekly reading list, is that the issue of bull markets are fine. Bull markets are something that take a long time. Bull markets the reason they call them bull markets is because they're steadfast, they're strong, they tend to last for a while. And bull markets are about 80% of the time in the market. Bear markets, conversely, are very fast. They're mauling events. That's why they're called a bear market. They maul you very quickly. And what we call a bear market repo here is how much the bear market takes back from your bull market. So while it's great to be invested during a bull market, always remember that everything has a cycle to it. And while the first half of the cycle is a lot of fun because we're making money, the second half of every cycle takes away a lot of that money that we've made. So it's important to understand that there are full cycles to the market, and you've got to manage effectively for both that. That's when we have a very strict discipline. And again, tomorrow's post covers these rules that you need to look for in managing your own money. Or if somebody's managing money for you, look at these rules and say, are they doing that for me? Because that's what's going to protect you and your money during the next downturn.